So the latest talk right now from everybody is what's the Bank of Canada doing to their prime lending rate, and therefore how is that impacting us as people who are buying and selling houses, and what's that interest rate going to do? So let's get into a little bit of detail about that. So the Bank of Canada interest rate increases have been top of mind for Canadians across the country all year so far. Real estate market here started with a boom in mid-2021 because house prices were high, competition was steep, interest rates were low. From mid-2020, the Bank of Canada had said they weren't going to increase the lending rate until 2023. Well, they lied, because in March, the bank increased the overnight lending rate for the first time since the start of the pandemic, and since then we've had 6 times increases to now what's at 3.75. Now with another increase in November, everyone's asking, should we choose a variable or a fixed rate mortgage whilst the interest rates are changing? So we want to go through 4 tips to help you decide. But let's first of all get into what are the different mortgages types and how do they work. Fixed rate. Fixed rate mortgage basically stays the same throughout the entire term of your loan, but means less purchasing power for buyers if those payments are higher. The length of these can vary from just a few months to 10 years, but very often 3 or 5 year terms. Generally have higher rates than variable rate mortgages, but can be such a great option if you're able to lock in at a low rate, because then you can budget consistent payments regardless of how the market's changing. So what about a variable rate mortgage? Well, these are ones that will change as the prime rate of your institution changes. These rates vary according to the Bank of Canada's interest rates. It's a great option if rates are low and expected to go down, and you've got some flexibility in your household income to see what those monthly payments could be throughout your mortgage term if they change. Variable rates tend to be lower than fixed term because they're a little bit less risky for lenders. You can also get a variable capped rate option, which means your payments are never going to exceed a certain threshold, but there's usually an additional premium that's going to come along with this. So generally speaking, variable rate mortgages have proven to be less expensive over time than fixed. With significant increases in the prime rate will increase the amount you're going to have to pay. Fixed rate, well, it's more stable. There's a significant difference though between the 2 types of mortgages, and maybe it's not worth paying that premium. So let's look over 4 tips to help you decide whether we should go fixed or variable rate. Number 1, determine if you're going to stay in that home long term. If you're not planning to stay in your home for the entirety of your mortgage term, that 2, 3, 5 years, or you're perhaps living it for a few years and then you're going to rent the thing out, there could be a penalty for breaking that mortgage. That penalty is calculated using what's something called the interest rate differential, where your lender is going to use the 2 interest rates to calculate the interest fees left based on both rates. The difference is what's owing when you break a fixed rate mortgage. With variable rate mortgages, homeowners can break your mortgage at any particular point. There's going to be some prepayment penalties, but they're a lot less than those interest rate differential penalties with fixed mortgages and what you'll do there. Number 2, let's have a look at your financial situation. So before committing to any type of mortgage, it's really important to look at your household income situation. This is the time to sit down, consider your job history, look if your current role is long-term or stable, or if you're going to be entering the job market in the future. It's always important to look at your monthly expenses and determine whether you have the financial cushion that's going to allow for some wiggle room in those monthly payments, especially if they're going to go up. Number 3, let's shop around for the best rate. Let's shop around to see what your options are, to see if they're available for both types of mortgages, and so you can compare them accurately. Many websites out there, they're going to allow you to compare the mortgage rates. You can also use a mortgage broker to shop around with different lenders and see what all the rates are available to you. Keep in mind that the mortgage application is going to be a hard hit on your credit and can cause some dips of about 10 points. So experts recommend applying to no more than about 3 or 4 mortgages in a short period of time. Number 4, let's leverage some experience. Let's get a financial planner, mortgage broker, or a realtor with a wealth of information that's going to help decide which option is right for you. You can always give a call, have a person, in-meeting person, or just set up a Zoom conversation. And if you need a great mortgage broker, we've really got them. So there's some tips to help you think about, should I go fixed, should I go variable? Because we're pretty sure there's another interest rate coming up in November and another probably 50 basis points. Fingers crossed we hit 2023 and it just flatlines or even goes down. That would be great. But As always, if you need a mortgage broker, I've got just the person for you. So reach out, get in touch, and let's see how we can help you make that right decision of, guess what, mortgages are changing, interest rates are changing, shall I go fixed, shall I go variable?